Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Barnett.
Hi, Casey. How's it going?
It's going good. We are going to talk about the cost of investing today. And we talk about this internally, but for a long time, I was afraid to really talk about fees. Oh, I don't know. They may not think it's worth it. Oh, I don't know. And that time passed many years ago as well, that these are our fees. These are what the products cost that we use, and this is why we're worth it. And I think a lot of people are afraid to talk about their fees. And honestly, if you're at a large financial firm like these big banks, these big brokerage houses, I probably would be embarrassed by my fee because they're ridiculously expensive, especially when they get into some of their products. But there's a lot of people think that their investment portfolio is free. They don't have to pay anything. Some people just don't know. They just like the person. So, yeah, I like that person. We'll pay their fee, whatever it is. Or they don't fully understand it, even when they're told. Which that's in the industry's fault, quite honestly. But it gets tangled, but it comes down to two things. There's the fee that you pay for the advice, and then there's the fee that you pay for the product that you're sold or is being used in your strategy. So we have a fee schedule that ranges from 0.5% to 1.5% annually at our firm. And obviously, the smaller amount pays the higher fee, and the larger amount pays the smaller fee. And then once you cross over a certain threshold, it actually just converts into a flat fee. You pay the same flat fee every single month. And what I always tell people is, like, it's 75% really for planning and our knowledge of how to handle planning situations throughout your life. And then about 25% of it is really for the asset management part, because that's about 25% of what we do here is manage money, where 75% of what we do is financial planning. Financial planning should always come first before you have any type of investment strategy. And then we send out quarterly statements. And in those quarterly statements, there's an invoice. And that invoice says, our fees are this. And you know what? That's sometimes the biggest hurdle for our newest clients is they get that invoice and they're like, I don't know why. I've never had to pay this before. Oh, yeah, you did. You were paying twice.
Wasn't very transparent.
You were paying twice that or 3 times that. And they go, oh, yeah, that makes sense. So understanding how much you're paying for investment advice and for the portfolios is very important. And so I want to talk through that today. So let's do the math. Brad, you got the math there. Let's talk about if we had $100,000 invested over different time periods and different fee levels.
I'm actually looking at a website from the U.S. Securities and Exchange Commission at investor.gov. And so this is an article that the government seems to think is important and wants all investors to know so that they can make their own informed decision, as Casey was sharing with us here. And the idea here is that if an investor had taken $100,000 and put it into investment and left it for 20 years and had earned 4% compounded annually over those 20 years, what would be the ending balance of that investment at different fee levels? And so you can actually see on this website at investor.gov the impact of fees on a real investment, on real returns over real periods of time. So over a 20-year period where we have an annual over 4% return on a $100,000 investment that has one, it has a 0.25% annual fee, or two, has a 0.5% annual fee, or a 1% annual fee. So you have 0.25%, 0.5%, and 1%, all on the same investment for the same period with the same rate of return. As you would imagine, the one that has the highest fee, the 1% annual fee, has the lowest balance of the others, of all three, over the 20-year period. The $100,000 investment over 20 years that earned 4% but paid a 1% annual fee has an ending balance of $180,000, compared to the one that was only paid, for the investor who only paid 0.25% for that same time period for the same amount over with the same return. They have a balance of just under $210,000. So the difference between the 0.25% fee over 20 years or 1% fee over 20 years in this example is $30,000 of lost earnings. That's the cost of investing. That's the difference between choosing a low-cost investment over a higher-cost investment, with everything else being the same. And it's worth it to take the time in the first year or even before the investment to do that due diligence. And if you have the capability as an investor, then by all means you should. If you find that daunting or difficult, then you should hire a financial professional to take a look at these investments for you on your behalf and help you choose which one is the most appropriate. And again, it's all things being equal, except for the fee. Choose the one with the lower fee, because that fee that's being pulled out of the investment of returns compounded over 20 years begins to add up. And that becomes the opportunity cost loss, because it's not just that you didn't earn it. It's just that it's also that when it was not in the investment, it had been pulled out of the investment as a fee. When it was not in the investment, it was not earning a return of its own. So you have compounding effect there as well.
Well, there's different types of fees as well. So there's transaction fees, which used to be pretty common, which now are almost non-existent at least the big three firms. So that's when you place a trade, you pay a fee. So it could be a commission. We talked last episode about A-share mutual funds. You're losing 4.25+% on the initial transaction. It could be a markup. That's when the dealer sells directly securities it owns directly to you. You would see that on the trade confirmation most likely. It could be sales loads. So those are 12B1 fees on I'm sorry, that's the front end of a mutual fund. Yeah. Yep. It also could be surrender charges. So early withdrawals from annuities sometimes carry hefty fees.
We see a lot of that, and that's really one of the saddest
it is
I've ever
seen. Here's a mediocre. Don't even get me started.
High fees, high surrender.
No, it's just sad. I mean, the look on people's face when they come in, and you have to share that information with them.
Yeah.
That if we take the money out of this annuity, they're gonna have a surrender charge of X percent, and the look on their face is just the worst in the world.
I've had 3 meetings in a row with people with annuities that were recently purchased, like they purchased them you don't buy annuities, you get sold annuities. So they got sold annuities, and it makes me angry. It actually makes me want to hire like a securities attorney just to keep on staff. And every time we get one, we just go after the advisor. Just the principle of the thing makes me angry, because it's never sold to like people like you and me. Well, not advisors, obviously. We would never buy an annuity. We're smart. But it's sold to people who don't know the difference, and it's sold to their fears. And anyway, I don't want to go down that track, but you want to avoid.
I couldn't help it.
Yeah, it just makes me angry. I had something on my LinkedIn recently where I posted a negative comment about annuity. Amazed how many advisors commented positively. Oh, I think these annuities are great. I bought them for all my clients. And I'm like, I hope your client's reading this post, because they might have some hard questions for you afterwards. Then you have ongoing fees. So we have transactional fees, We don't have transactional fees here at our firm. Those fees are covered by TD Ameritrade, right? So we
Right.
don't. Most everything's transaction fee free.
Or commissions. A lot of these firms, especially Fidelity, Vanguard, Schwab, TD here, we're not charging commissions when you're making those, no transaction fees or commissions on the sell. There are still some wirehouse and broker dealers that are charging not the hefty commissions they used to when they sold various funds or stocks, but there's still some commissions within that.
So we have ongoing fees as well. So we have investment advisory fees, which technically that's what our fees are. We're charging investment advisory fees. We often call that a planning fees. Annual operating expenses, so mutual funds, exchange traded funds, they have operating fees that they charge. Those are usually easy to find. You just almost type in the ticker in Google, and there'll be a Morningstar report that will show you what that fund fee is. That'll be less than 0.25% in my mind. It's amazing how many funds charge way more than that. 401k fees. So these are expenses in operating and administering a 401k that often get passed to the participants. I'm seeing a movement where companies are starting to cover this fee now, which is the right thing to do. But there's still a lot of, especially small business plans, you carry the load of the cost of the plan, which can be expensive. And there's not much you can do about that unless change jobs or lobby management for some changes. And then you have the annual variable annuity fees, which I'll try to stay away from that topic. There could be additional fees related to account transfer, account inactivity, wire transfer fees. Those are usually fairly small fees in the scheme of things. What you're going to be looking for is it's those advisory fees and then the investment fees or the fund fees. And you add those together to come up with your total cost.
Well, advisory fees are becoming pretty standard just across the board in the breakdown of them. But like you mentioned, it's those other fees like those expense ratios. And we've discussed it in previous podcasts where on top of that, let's say 1% fee, there could be 0.5% or up to 1% in expense ratios in the funds they're using. So you could be paying over 2% and not even realize it.
Yeah, these annual operating expenses that we talked about just in that previous example that I shared, they may seem small, and they're presented in such a way like 0.25% or 0.5%. Boy, that seems like a small number. But when you're investing hundreds of thousands of dollars over long periods of time, these mutual fund companies, these product manufacturers, when they're investing hundreds and hundreds and hundreds of millions of dollars, charging these small ratios, they're making tons of money.
Yeah.
It's just
that's
huge amount of money that's coming through these fund companies.
That was my whole, I want to call it my monologue, but it was a rant about ESG versus the S&P 500. Large cap ESG fund costs you 5 times what the S&P 500 does, and yet the ESG ranking's almost the same. So it's a great way to be able to charge 26 million more dollars is what BlackRock can charge for having an ESG fund that performs exactly like the S&P 500. Yeah, and it's a game.
Yeah.
All to have the ESG label. So that's an example of the standard, I think, is the core into ETF. So you got to tell me that this fund's got to beat the core ETF to make it worth paying that extra premium, which in some cases, the ETF, so the S&P 500, IVV, VOO, SPY, that cost is around 3 basis points or 0.03 of 1% annually. So imagine a fund that charges 1.15%, which is fairly common at some of these bigger firms. Think about that. That means that fund has to beat the S&P by 1% every single year in order to keep up with it. And we'll have an active versus passive management. Discussion. But the bottom line is that it's hard for them to do that over the long term.
It is. So it is because that fee is actually it's like the wind in your face. Okay, like a pilot trying to fly into the wind. It's like a boater trying to go upstream in a river.
Right.
You're constantly fighting it day after day after day after day after day. And we should take just a half a minute and kind of, define some of what these fees are that you would see. You would see a management fee. You would see an operating expense. You might see transfer agency fee.
12B1 fees.
And then a 12B1 fee. Why do they call it a 12B1 fee? And that's exactly right. Cases are shaking his head like this is crazy. And the reason they do it is so people say, I don't even know what that is.
Right.
What a 12B1 fee is, listeners, is a sales charge to the person who sold you that fund. They receive that as an ongoing stream of revenue from your investment.
Yeah. Yeah.
So they just call it what it is.
Well, they're too embarrassed to call it that. They want to try to push it under the rug back when you could do that in the industry and somewhat get away with it.
Yeah, a standard 12B1 fee is 25 basis points. Our whole
Right.
portfolio is a third of that,
Hey, thanks for listening to today's podcast. I did want to kind of break in here halfway through and talk a little bit about hourly financial planning. This is a concept that we helped launch just a few years ago at our firm. So many firms out there have minimums, $3, $5, $10 million minimums to get access to true wealth management. And one of the things that we have been working on is getting wealth advice accessible to anyone out there who's willing to pay for that. And through the hourly planning process, it's not hourly like you would think your attorney would do hourly. It's really more, we figure out how many hours a project takes, and then we simply quote you a flat fee. We work off that flat fee for the duration of the project. So we help, I'd say, probably anywhere from 3 to 6 families a week through this hourly process. And so many times we're giving second opinions. We're looking over someone's shoulder who's doing it themselves, or we start off working that way, and over the years, trust develops between our firm and the client, and we are asked to then manage assets going forward. So as we talk about fees today, we talk about different types of fees. One of the things I wanted to point out was there are hourly services available or flat fee services available to where you don't have to turn over all of your assets for management if that's not what your goal is. So if that's something you're interested in, I encourage you to go to wiserinvestor.com. You can simply schedule a consultation with myself, with Brad, or with Matthews, and we can talk through more about that process. Thanks for listening, and then have a great day. So there's some questions you can ask. The SEC has great guidelines on that, by the way, if you want to see this list. But what are all the questions to ask an advisor might be, or an existing advisor? What are all the fees related to this account that I will be charged directly or indirectly? I think that kind of encompasses it all.
It really does, especially the indirectly.
Yes, because a lot of times advisors go, oh, well, you're only paying me X. Because if you ask the question, well, how do you get paid? That doesn't cover where all the fees could be. What fees am I being charged directly or indirectly? Do you have a schedule that lists all the fees that will be charged for investments and maintenance of this account? That is a disclosure that we give every single prospect, whether they meet with us virtually or in our office. That is not required by other firms. It's required as fiduciaries in our business, but is not required by others. What fees will I pay to purchase, hold, and sell this investment? Will those fees appear clearly on my account statement or my confirmation? If not, how will I know about them? How can I reduce or eliminate some of the fees I pay? For example, can I buy the investment directly without paying an investment professional? Can I lower fees if I open a different type of account? So at larger firms, there's a lot of legacy accounts. There's a lot of different types of accounts. I know at one firm, there's at least 3 different types, depending on what investment products will be available to you. So there's no reason to be in the Cadillac if you needed the Ford, right? And so you have to kind of get an idea of which one's best for you. Suitability is the guideline that most firms operate under. So you have to use the phrase, which one is best suitable for me? In a firm like mine or ours, you would say, is this in my best interest? Which our disclosures tell you that we have to work in your best interest as a fiduciary advisor versus selling you a product. We don't sell anything here at this firm. Do I have to keep a minimum account balance to avoid certain fees? Some firms do have minimums. I don't think most. I think a lot of firms have moved away from that, or they'll tell you that if you fall below, or they should. Here's a good one to ask. If you look inside your portfolio and you see a bunch of mutual funds, how do the fees and expenses of the product compare to other products that can help me meet my objective?
And this is where it takes a true investment professional, not just an investment salesperson, to review the different products and compare them side by side to see if there is a product out there that is of similar nature and similar content with similar objectives at a different fee that they could offer to you.
Another one, too, is you have mutual funds and that's just all that's offered. Does the product have more than one share class? Mutual funds do. If so, fees compared across share class, or how do the fees compare across share classes? What is the overall lowest cost share available, and how do I qualify for that share class? So that's something that you actually do here, Brad. We inherit mutual funds all the time, and because of the low cost basis, it's not advantageous to sell it. And so we have to hold it and kind of work it in, build around it. But you'll call.
Well, we'll call directly to the fund company and ask if there's a lower share class.
What's interesting is a lot of times there is.
Yes, quite often there's a lower cost share class, one that does not have the 12B1, for example.
Right. And so we're able to transfer into that where it just came from the firm where they probably could have gotten the same thing, maybe.
Yeah.
Obviously, 12B1 is probably that environment. But
then again, it's the suitability factor versus the fiduciary.
That's true. It's suitable for them, but it wasn't in their best interest, but they don't have to operate.
That's right.
In the best interest. So, another thing to ask an advisor, and don't be ashamed to ask this, is how do you get paid? Do you get paid by means other than commission? For example, like the amount of assets you manage, if yes, then how, and then do you have a choice on, or do I have a choice on how I pay you? I've been asked this a few times. We do have a few clients that don't want money deducted from their account, and they write checks directly every single quarter for our services. It's very rare. But yeah, I think that the question of what are all the fees related to this account that I will be charged directly or indirectly? If I had to answer that question, that would cover everything that we charge. I think that would be the same for anybody in our industry.
And by asking these questions to your financial advisor, what you're really doing is you're clearing the air, okay? You're setting a level of expectation between each individual that you can communicate on a high level relative to your account. And so your expectations then should be met. If you've done this and then all of a sudden there's an there's an a gotcha moment, then clearly expectations haven't been met, and it may be time to reevaluate that relationship.
So we have this, and I'll touch on here briefly, is you want the lowest costs going forward, but there is an advantage to having professional advice. Specifically, Vanguard talks about this. Advisors as alpha, alpha meaning making a difference, right? So Vanguard says that having a financial advisor typically adds about 3% rate of return to your portfolio every single year. But it's not always from investment outperformance. A lot of times it's behavior coaching. And so when you have crises like 2020 COVID, the financial crisis, all the things that popped up in the middle, human nature sets in, and we don't want to have that pain. We don't want to see losses, right? Especially here in America, we're not used to losing, right? We're all winners. And if you're not a winner, they give you a pill. So
you get a trophy. Anyway.
You get a trophy anyway. That's right. So the thing is, when human nature kicks in and it's fight or flight, and we decide to flight, and we sell our portfolio in the worst possible time, we typically won't buy back the portfolio until the market's nearing the high again, because that's when we feel better, or we feel like we're missing out, or we have missed out. We got to participate. And that move right there destroys wealth. It destroys portfolios. We have to be able to get through some of the worst of times, but keep our portfolio intact, which is why we always talk about diversification, adding short-term bonds to portfolios to help with volatility so you can sleep better at night. There's a lot of different ways that you can handle that volatility going through. But when we had the crisis and the COVID sell-off in early 2020, you and Matthews are out there working hard on portfolios and monitoring and doing the research. I just became a camp counselor. And I went from one call to the next call to the next call going, hey, nope, this is what we're going to do. This is the action plan. And we had an action plan. That was to rebalance our portfolios, sell our bonds for gains, and buy more shares of stock when the stocks were low. And we're not going to time it perfectly. No one ever would. It's no different than going to Vegas as far as timing tops and bottoms. But we had an action plan. We did that action plan.
Yes, we executed on that plan. When it got to the point where the targets in the portfolios and the weightings in the portfolio, became overweight equities or overweight bonds, we made the decision. By having that sort of plan, as you talked about, it allowed us to execute on it and to move forward, whether to keep continuously questioning, is this the right, is this right, is this right, is this right? We had a plan, we executed on it, and we moved forward, and all the portfolios benefited from it. I think I've heard that Warren Buffett, famous investor, the Oracle of Omaha, etc., he summed it all up by saying the way to make money in the stock market is to be invested at the bottom. By staying invested at the bottom, you get the full gain coming out of the bottom. Right. If you miss the bottom, that means that you've sold, and the chance of you getting in at the bottom are almost zero. So you're going to miss some of that return stream if you're out.
So really a job of a financial advisor is to construct a proper portfolio, give you behavioral coaching, how you should be reacting to whatever's happening, good and bad, right? There's people who want to change their investments to all stock when the stock market's doing really well, and they want to change it to majority bonds when it's doing really bad. That's the same thing as buying and selling at the wrong time. So it's developing that portfolio, coaching the behavior on that portfolio, and then also there's just wealth management. There's all the things that get attached to all this. The life insurance, if you check out early, can we protect your family and your spouse's retirement? Long-term care in case we have big expenses. Doing estate planning, something happens to you, what's legal documents that we have in place to pass on assets efficiently. You think about health insurance now has become a big issue, is being able to connect them or advise them on the health insurance side. And then the overall just classic retirement plan. Do I have enough, or how much can I spend? Those are all things that kind of fall under the wealth management bucket.
Right.
And then they have these 3 points, but I think the fourth one is just always being there, being available for questions and strategy talks about, hey, how do I get through this, or how do I handle this? That's what you pay an advisor for. Unfortunately, in our industry, we kind of defaulted to product sales, and that we sell a product, we have to keep selling products to hit our quota, and so we end up with 3,500 clients, and we don't really know our people. We don't really know clients. We keep our groups limited to about 150 per team here, and that's so we actually know our people. We know the people and what our job is and how we can best guide them. And so I think the future of our industry ought to be a lot of micro firms like ours, as opposed to these big, large firms that have thousands of clients and they don't know who you are.
Right. And by keeping the teams servicing a certain number of clients allows that team to fully understand that client group, that individual even, that has the portfolio, that has the circumstance. The real value in a financial advisor firm like ours is in the planning, making those decisions that will play out in a positive effect over long periods of time is where the real value is. So we maintain diversified portfolios that meet the objectives, but in the planning is where we're really providing the best value for the client. And that's where we're earning our 3%, because our withdrawal strategies, our asset location strategies, right? Our Roth conversion strategies, are designed to have a long-term positive valuation in a client's overall net worth. And that's where I think the value of the 3%.
And what's interesting, this is unique to firms such as ours. There's many of us around, we're just harder to find. Our name's not going to be on the stadium downtown, right? So, but we're out there. Google searches are we're all learning how to show up, how to say, hey, we're here. But financial planning is something that everyone says that they do. But if you do a financial plan and it's done in 20 minutes, that's not a financial plan. And that's what it is at most firms. They sit down, oh yeah, okay, yeah, I typed in all these numbers, yeah, you'll be fine. You just did a basic, very over the top view plan going, okay, yeah, you have enough assets to live on X amount, but there's so much more to it than that. Typically, a good financial plan is going to be 5 or 6 hours of our man time doing the research and the data to build that plan. And that's where the value comes in. And then understanding what's happening with the government and changes that affects those plans, and then being proactive and calling up and saying, hey, you need to do this because this just happened. That's what a planning firm does versus a investment sales firm that I think people are used to and think that we're all just like that. And that's not the case at all.
And it's not the case at all, right? So,
well, hopefully this helps you understand a little bit about fee structure and what questions you should be asking. And if you need to dive deep and want further analysis, we're easily able to do that because this is our language. We understand how it works, and we can help you calculate what your fees are and if you think that there's value there or not.
I think it's a good topic. I think this is something that as a listener, I hope that you can take away from it and immediately dive into your portfolios, review your fee structure, and begin asking your advisor some of these questions that we just talked about in order for you to have a wiser retirement.
Thanks, guys. Talk to you later.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.